The spirit of innovation is deeply ingrained in America, and Google is helping Americans innovate in ways both big and small. From improving emergency response times to protecting against cyber attacks, local, state, and federal governments are innovating with Google AI. This is a new era of American innovation. Find out more at g.co/American Innovation.
Reality radio for a really great future. We're talking real money.
Well, people are a little crazy. You know that. You know they're nuts. But there's one thing we've been crazy about for thousands and thousands of years, and I guess when we were initially nuts about it, there was good reason. But now, the reasons are fewer and farther between. Today, even though we hate to do it, we're talking about gold. That shiny, malleable metal that people have used as a means of transporting wealth. That was what was the useful purpose of gold hundreds or thousands of years ago before electronic banking. It was one of the few ways you could transfer large amounts of money in a small, relatively rare form that everybody could agree had value. And that's the only reason that it has value, it had value, or it has value today, is that just like the U.S. dollar, we agree that it has a certain value. Past that, it's just a rock.
Yeah, and here's the other thing it has. It has from UBS, RBC Capital Markets, Goldman Sachs, JP Morgan, Van Eck have all recently published positive comments about gold. Guess what? In the last few months, you got to own gold because it's at $3,600 an ounce. Costco, yeah. And it goes as far as Jeffrey Goonlatch from Double Line, who said, I think of gold as a real asset class. It's no longer for lunatic survivalists and wild speculators. Well, it's for them still, too, of course. But
okay, why, though? Why do you think they've changed their tune?
You're supposed to be the cynical one here, not me, right? I'm the Pollyanna.
Yeah, but this one's so blatantly obvious that even an eternal optimist like you can become a little bit more cynical when you think about it because, gee, what's gold done over the past couple of years?
We'll get to the numbers in a moment, but what they're claiming, by the way, is that with national debt continuing to balloon, the perception has shifted to the fact that central banks may have to hold something other than dollars, de-dollarize their reserve assets. They're aggressively buying gold. Gold is also traditionally, Don, as you know, viewed as a safe haven during periods of macroeconomic uncertainty. By the way, when does the macro economy not have uncertainty in it? I mean, it always has something, right?
And I would challenge you to name a time in the last century plus when gold was used as a currency in the world in general. Just name one period. We've had some macroeconomic crises. I mean, if you don't think World War II was a crisis, then you weren't paying attention or you haven't read your history. Was gold the means of exchange during World War II, that horrible crisis?
No, it was not.
It was not.
It was not. No.
Great Depression.
Yep. That was, you brought piles of Deutschmark in to buy a loaf of bread, right?
Inflation in the 1970s and 80s. Gold? No. As a matter of fact, after gold's peak in 1980, it took it about 20 years to get back to that level again.
Well, you wanted to mention the numbers. Here you go. Gold, they're saying, for a 20-year period ending August 27th, 2025, has an annualized return now of 10.7%, which is pretty doggone good until you consider the longer history. Now, you mentioned 1980, for example, but here in this Morningstar piece, they mentioned a couple of lengthy periods where you had to wait a long time just to get your money back. And I'm trying to pull that up right now. But 1987, it says, into inflation-adjusted terms, you didn't get back to your even Steven money till November of 2005. So that's a long time to
that's a pretty terrible
That's a long time. And so there are these periods, and if you look at a chart of gold, you can see it. If you step back and look, it has long periods where it does nothing or goes down, and then it has these periods where it just goes whoosh, like it's done lately, and then we're going to go back to this other. My worry is a lot of people, because of the aforementioned analysts who are now telling you you've got to own gold, that people are rushing into it.
Yeah, and I just did some looking, finding some numbers on it. From get this, back when gold was actually worth something, from 1871 to 2001. This is from Larry Summers' book, Stocks for the Long Run. Gold had a real return after inflation of 0.1%.
Give us the period again.
1871 to 2001. That's 130 years.
That's a long time.
Stocks over that same period, actual, real, after inflation return, U.S. stocks, 6.8%.
And for those of you who say, for me, it's personal, just because I lost a family member to the gold rush in the 1840s or 1850s, no, it really is about the numbers.
None of my family was dumb enough to drive clear across the country for the on the off chance that they might find gold.
Yeah. Okay, but that worries me a bit, but the bigger worry is if you have to own gold, everybody's out there pitching something. So I sent this to you, I believe. There's a new fund that somebody just sent me because I'm a financial advisor, and boy, I might need this for my clients.
Oh yeah, I bet you do.
That's KGLD. It's a smarter alternative to just boring old GLD. It has income paid monthly. It tracks gold price with minimal minor equity noise, and that's minor with an E, not an O. And it's tax efficient, optimized for advisor-held accounts, which, as you know, is very important.
So they found that special gold that pays a dividend?
Yeah, apparently it every month you put it in a box slowly over time.
A little bit drips off and into your hands, and that the gold bar gets no smaller.
Exactly. It's still there. Same amount in the morning, but it's paid you out. But
I'm sorry, I hate the financial services industry sometimes. I just hate it.
So blatant to capitalize on what's happened with the price of gold. By the way, for the pleasure of all those things, the expense ratio is 1% because I think you looked at it, and there's a lot of work that they do with this particular
how
fund.
do they pay a dividend when gold does nothing?
Yeah.
Let's think about gold for a minute. I want you to think about it logically. Okay? I want you to imagine a bar of gold. You just went to Costco. You bought that little baby bar of gold for $3,500 or whatever the ridiculous amount it is. Remember, it's just an ounce. So it's not a very big bar of gold.
No.
It's a teeny baby bar of gold. Now, set that on your desk. Lock the house down because you know the bad guys want it. Leave it there. Come back in 10 years and tell me how much bigger that bar of gold has grown. Has it grown any at all? You know the answer. It's still the same dang size.
Yeah.
Gold doesn't grow. Gold doesn't pay interest or dividends.
Thank you. And by the way, you're not the only one who said that. The great Warren Buffett, a pretty successful investor, says this on a regular basis. There's another quote in this article that he mentions just those two things. No dividends, no growth, just sitting there doing what it does. But the question I think that people are going to ask us is, at $3,600 an ounce, is it going to keep going up? So what's your take there, Professor? We're going to see a continued rise in the price of gold?
I am pretty darn sure it's going to fluctuate.
Might go up?
It's going to go up. No, it's going to go up and it's going to go down. And it's going to go up and it's going to go down. And it's going to stay the same for a while before it goes up or goes down. And then it'll go up or down and down.
And it might be 1987. You may have to wait till 2005. Like 18 years to get back to zero again with your investment. So, and this is another warning, and I will make this very clear. When you buy things that have already appreciated at a very high rate recently, you could pay a steep price for making that purchase because there are often two sides to that mountain, right? Things could come down the other side. So buying an asset after it's gone up dramatically is not a good strategy. And here's another one. For those of you who really got to be involved in gold in some way. Now, we do not own gold the metal, nor do we invest in gold the metal. But we do own companies that are involved in the gold trade, mining companies, processing companies, probably jewelry
they can
companies.
grow.
Yeah. They can get bigger.
What is an ounce of gold right now? I've tried
3,600.
3,600.
Yeah, it's had a pretty good run.
So 20 years ago, gold was about $770 an ounce.
Yep.
Okay? If you had taken that same $770 that you would have put in gold 20 years ago, and you said, I'm gonna buy this company that's doing really, really well. It's making these iPhone-y things, and all this computers and stuff. I'm gonna buy Apple, and just let it sit there, just like I've let the gold sit there. And we watched the gold become worth $3,200. $3,600. Yep. We would have watched Apple.
How much?
Become worth $81,000.
And do they issue a dividend?
They do now, yeah.
Yeah.
Yeah. And they grew.
Turns out. So, again, don't get caught up in recency bias.
Well, and to Gundlach and his ilk, you're still buying it as a survival tool. That's the reason you're not buying it because it's a money-making asset. You're not that stupid. You're buying it as a currency of last resort.
I'm using it to buy guns, canned food, and ammo when the time comes, right?
Yeah. In your bunker by the lake.
That's right. I'm bunkered in. So please don't rush out and make that purchase.
He figures he's got a steady supply of fish. He's got fresh water.
Yep.
You're all set.
I can defend it pretty easily because unless you have a boat, I only have to defend from one side.
From one side, yeah.
Yeah. Well, so good luck. I guess you could storm the dock there or something. I guess that's possible, but
with your little tiny inland navy.
Very small. All right.
Question time.
Lots of questions. Thank you. Keep them coming. TalkingRealMoney.com. Click on Contact Us. And you can do them this way. Type them. And this is a lengthy one. Or you can speak them and be on Don's Friday podcast, which my grandsons and I love listening to every Friday while we're driving to the, as they call it, the shirt store. Because I do every Friday.
Every Friday you go shopping for shirts?
No, I go to the dry cleaner. They call it
the shirt store. Yeah, that's right.
You have to go to the shirt store today, Grandpa.
Tom has his shirts laundered and pressed.
Yes, I do.
I wear a T-shirt.
Yeah, well,
we are so polar.
And you're in a small room. Doesn't matter. No.
Yeah, all right. Go ahead. Give me a question.
This comes from Tumwater, Washington. Dear Don and Tom, I'm helping my mom and dad who are in their early 80s with their taxable investment account with an Ameriprise firm called Caribou Wealth Advisors located in Spokane. Now, okay, I don't even have to read beyond that because
it's Ameriprise.
Let's see. What am I going to say about Ameriprise?
What's
a broker-dealer.
No, just keep going.
Okay.
What's he asking, and then we'll tear him apart.
Yeah, he gives the name of the advisor. We're not going to do that. There's $275,000 in the investment account. Parents are covering day-to-day expenses with pensions and Social Security. They do receive a small amount of money each month from the account. The pot of money is for unexpected expenses, including long-term care needs. My parents were burned when they retired with heavy equity exposure just before the dot-com bubble burst. So my mom is adamant she doesn't want to lose any money, even if it's lost to inflation. I reviewed their portfolio's monthly statement and became concerned. Given my mom's low risk tolerance and the amount of cash and bonds with minimal stock exposure is likely appropriate. However, 38% of the portfolio is in high-yield municipal bonds and an annuity. Mm-hmm. This made me nervous. I'm hoping to get your thoughts on the firm's conflicts of interest, asset allocation, high-yield bonds compared to your recommended bonds, how much riskier their portfolio is. And by the way, and thank you for, John, you spent a lot of time on this. And your parents, I hope, honor the fact that you're trying to help them, which is a very difficult thing to do in many ways, to try to tell your parents, oh, you really should fix this. But he went through all the securities that they hold. I just pulled up a couple of them because they're like 20. I don't think you need 20 securities.
But give me a couple of the highlights.
Well, there's J.
Or lowlights.
Yeah, J, T,
Yeah.
B is in boy, D is in Don, X is in X-ray.
Wait a minute.
JTBDX.
TBDX is the
Because
John
this is
Hancock
the-
Municipal Opportunities Fund.
Yeah, and when they say opportunities, that's I get nervous because I think, and it has an expense ratio of almost 60 basis points.
Whoa,
By the way,
that's
you
a
can go
lot
buy-
for a bond fund.
Yeah, you can go buy the Vanguard Municipal Bond Fund for a tenth of the cost, 0.05, and own a more diversified. And I think this is opportunities is high yield, correct, of some kind.
Hold on, I got to find it. Give me the symbol. I was in the wrong place.
JTB. B is in boy, D is in Don, X is in X-ray.
All right. John Hancock Municipal Opportunities Fund is coming up very slowly on Morningstar. Why are you moving so slowly? I want to look at this, get the breakdown. Oh, my goodness. Let's see. 25% of the portfolio is unrated paper. 20% of the portfolio is triple B or lower. So that's
Half of it is speculative in some ways. I
Yeah.
mean, again, this is not conservative. I don't really want to go through all these. There's too many securities, for one thing. They have these little tiny amounts in each one. No,
which is a
reason for that
typical
with
broker
275,000.
portfolio because
Yep,
we're
it
always
is.
looking for the latest hot thing or the latest
right.
commission or
Yep.
here's, as a former broker, let me tell you, it's the latest wholesaler who happened to come into the office and say,
The last
here's a
one.
great story to tell your clients.
Yep.
That's
And so
truly
I don't
what
know
happens.
if you want us to look at. I would not work with somebody who's going through Ameriprise. I would not work with somebody who sold my parents an annuity. I would not work with a portfolio that's this many securities for this amount. There's no reason, et cetera, et cetera. So if you're looking for another reason to tell your parents to, take a hike, then we'll be right there behind you. The question, frankly, with 275,000, and you'd have to go in and look at this. I'd probably put them in two funds.
Yeah,
Make
exactly.
it real simple.
Yeah, I'd have like VT and BND.
Yeah, I probably. Maybe it's 30% because your mom's worried about volatility in 30% in V as in Victory, T as in Tom, and 70% is BND because then you get some exposure to stocks. I wouldn't be messing around with these guys. No way.
Yeah,
Do you wanna
and
look
the
them up or
last
not?
time I looked at Ameriprise's, if they were, but in this case, wait a minute, is that a loaded fund? Yeah, I think that's a loaded fund.
I didn't find the load. I just saw the
Hold
expense
on.
ratio. So
Yeah, let me just look here. I'm thinking because I'm trying to decide if they're okay, then they're doing okay. If they sold them this fund, then they're acting as a semi-fiduciary.
Okay.
Which means they're charging a fee. And the last time I looked, and I probably should look again, but the last
Caribou
time I
with
looked,
two O's, by the way.
yeah,
instead
two
of-
O's, Caribou, like in Halloween.
Yeah.
But the last time I looked at Ameriprises, they had one of the highest
They did.
fees in the industry.
They're going to tell you they don't charge that.
It
but
was
it's
over
available.
2% for their
Yeah.
maximum fee.
Yeah.
My guess is they're charging no less than 1.5% on that
That's
account.
probably right. Yeah.
Maybe
And I
2.
don't think you need it for this situation.
No.
That's my call. But
Nope.
So we've tried to give you all the ammo we can. And by the way,
And there were commissions. There were commissions paid on the annuity. That I
okay.
can
And by the way,
state.
throw it on us. Say I asked these other people, and they said you should get your money out of there. Don't put it on yourself because you want to keep your relationship with your parents. I get that.
Problem is these people make it very hard to leave.
Oh yeah. Of course they will.
I mean,
And maybe it's not even worth it
They
in their
act
late
like they
80s,
take
so.
it personally.
Oh, yeah. No, it's ridiculous. Ron writes us from Vinton, Virginia. Hey, Don and Tom, been listening to your show for years. Balanced funds and target date funds tend to be made up of a fund of funds. Mm-hmm. So what he's referring to the fact that if you buy the Vanguard Target Date 2050 fund, it has a bunch of Vanguard funds in it.
That is correct.
If I don't mind the extra work, would it be better for me to own all the funds separately in my portfolio, rebalance once a year, and then take my RMDs out of the funds that are doing well? Instead of owning the target date fund, which is going to do
building
that
your
inside
own
of it.
fund.
Yeah.
I mean, it's not going to. It's not going to save you much in the way of money.
Nope.
But it might make for slightly more efficient withdrawals, better balance down the road, possibly. Do I think it's worth the trouble? I put a high value on my time. I really do. I put a high value on my time. And if I can pay somebody else to do something and I pay them less than I think my time is worth, then it's worthwhile. And in Vanguard's case, they don't charge anything extra to wrap it.
It's just the cost, yeah. Mm-hmm,
it's just the cost of the funds themselves. So your cost is going to be identical to what it would be just being in the fund, and the fund does the rebalancing all the time for you. That's the other advantage, is it's going to rebalance far more often than you are likely to rebalance it. So I'm starting to have a really hard time seeing.
Here's the only reason I would consider that is because I could make the asset allocation more specific to own small, to own value, and to own international.
To your personal risk profile. Yeah.
Yep.
Yeah.
That would be the only reason.
That's
Otherwise, no, I just let it be. This comes to us from Tigard, Oregon. It's Jason who writes, I've been saving into my HSA for 15 years now and have been investing in an aggressive growth exchange-traded fund. My company adds money into it every paycheck, so I love the free money. By the way, we love free money too, Jason.
Yeah, we all do.
I'm 55 years old, maybe with 5 years left until I retire. Wait, people retire at age 60? I didn't know that. That's crazy.
He must have a job he doesn't like that much. I'm never retiring.
The people I talked to today said, well, Don says he's never retiring. I said, well, yeah, because he's locked in a small room and it's padded. He'll be okay.
And it's heavily padded.
It is actually. I've been there. Jason, the actual question is, at what point do I start spending it? His HSA, his health savings account. When does he start spending it?
When you either need the money or want the money.
Yeah, you can save your receipts, right? And then just start saying later on, if you want some income, you can match those up with old receipts, get the money.
I guess you could. I don't know the rules that well, but I think so.
I think so. And so here's the thing. You get good tax treatment on the growth. I wouldn't take it out until I had to have it.
Yeah, but that's what I say. When you need it, or want it. I've
Fair
always wanted to do X. Well, I've got the money in my HSA. Why don't I just do X while I'm young enough to enjoy X?
Yeah. It can be used for any of those expenses. So sure, why not?
Yeah. That was easy.
Yeah, that's easy.
Anything else?
Congratulations on saving and getting the free money. We have the same thing. Oh, you're not in it. That's right, because you have a different plan or
I'm
something?
in the 401 and get free money.
You're not in the HSA, though.
I can't be in the HSA because I was stupid. I was stupid.
Okay, there's
At
that.
age 65, I got a thing from Medicare that, said, hey, guess what? You're now eligible. And I went, well, I don't need any of the other stuff. But they said you can start getting just have it. You can have it now at 65. I took it. And if you are on any part of Medicare, you can't have an HSA.
So you're no longer eligible because I am in the high deductible plan, and I do use the HSA.
But you didn't take Medicare Part A yet.
No.
Right.
No.
See, that was my dumb thing. I thought, well, what's the harm in having Part A in case something goes wrong? I have a backup plan, but no.
That's that. All right. Thank you for all your questions. Thank you for all your
Another
interest.
admission of stupidity by me.
Keep them coming. We're all enjoying it.
I've got plenty. I have so many to share with you. Just dozens. Anyway, thanks for being a part of the show. We really love having you as part of the podcast, and we hope you'll tell friends and more. Sort of podcasting is my life, so I'm a big fan of people listening to podcasts. Just listen to more podcasts, particularly Talking Real Money. And go to TalkingRealMoney.com. Send us questions. Go to TalkingRealMoney.com if you want some help from an advisor for free with no obligation and no cost. Well, I guess free implies no cost, doesn't it? That was redundant.
Yeah.
Do you have anything else you would like to add before
I want to say
we
thank
draw
you.
this to a close?
No, I've talked to this was a very busy week. I love talking to all of you, so thank you for listening. Thank you for your kind comments about the education we provide and for the humor that we try to provide as well. So thank you for all that.
Try. Emphasis on the word
I
try.
talk about, you said your mistakes, I'm admitting mine. I try to make it a little lighter. That's all.
If his kids would quit giving him dad joke books, we'd all be happier.
I think I have about half a dozen of them. So,
all right, thanks for being there. Take great care of yourselves, and please remember, pretty much 5 days a week. Actually, when you throw a live Saturday show in, like 6 days a week, you can listen to us talking real money.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor.
Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services.
Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.